When it comes to financial literacy, inflation is considered the silent killer. Inflation has been hitting everyone's wallets pretty hard lately. But what if there was a way to not just survive inflation, but actually thrive during these times? Well, that's what we're going to be talking about today. We're diving into the mind of Warren Buffett to understand how he's grown his wealth during periods of high inflation. I'm sharing 5 of Warren Buffett's most powerful strategies to beat inflation and grow your portfolio. Buffett's first rule during high inflation: find businesses that can raise prices faster than their costs go up. When inflation is high, the cost of everything goes up. Most businesses try to pass those increased costs onto customers by raising their prices. But not all businesses can do that successfully. Some businesses, like those in competitive industries, get their profits squeezed. But other businesses, the ones Buffett loves, have pricing power. They can raise their prices and customers will still pay. Think about things you buy no matter what, like your morning coffee or phone service. These are products with inelastic demand. Buffett said the best businesses to own during inflation are like toll bridges. They control something essential and can keep raising prices without losing customers. We've talked about what Buffett likes during inflation. He often emphasizes the importance of investing in assets that can keep up with or outpace inflation. This includes businesses with strong pricing power and tangible assets like real estate. Now let's talk about what he avoids: traditional bonds and holding too much cash. These are seen as risky in an inflationary environment because they don't grow in value. When inflation is high, the value of cash erodes quickly. This means that the purchasing power of your money decreases over time. That $100 you have today won't buy you nearly as much a year from now. This is a critical point to understand for anyone looking to preserve their wealth. And bonds, they're basically loans that pay a fixed interest rate. While they might seem safe, they come with their own set of risks. When inflation is higher than that interest rate, you're losing money in real terms. This is because the fixed returns from bonds don't keep up with rising prices. For example, if you're getting a 4% return on a bond but inflation is 6%, you're losing 2% of your purchasing power each year. This can significantly impact your long-term financial health. Look back at the 1970s, a period of high inflation. During this time, many investors saw their real returns turn negative. Long-term bonds had negative real returns for an entire decade. This serves as a cautionary tale for those relying heavily on bonds in their portfolios. Inflation can silently eat away at your returns, making it crucial to find investments that outpace it. Diversifying into assets that can grow with or exceed inflation is key to maintaining and growing your wealth. Now that we've talked about what to avoid during inflation, let's dive into what Buffett recommends instead: real assets. When Buffett says real assets, he's talking about things like real estate and productive businesses. These are tangible assets that have intrinsic value. Let's start with real estate. Real estate tends to appreciate with inflation. As prices for goods and services go up, so does the value of that apartment building you own or that piece of land you're holding onto. Plus, real estate can generate cash flow through rents. As inflation pushes rents higher, your income from those properties increases. When it comes to businesses, Buffett prefers those that own productive assets. These assets tend to increase in value during inflationary periods. Real estate and productive businesses have historically outperformed financial assets during periods of high inflation. Now, here's one of Buffett's most important pieces of advice. Invest in yourself. This isn't just about putting money into stocks or bonds. It's about dedicating time and effort to improve your own capabilities and knowledge. Buffett's always emphasized that the best investment you can make is in your own education, skills, and earning potential. He believes that the returns on self-investment far outweigh those from traditional financial markets. This is something that inflation can't touch. Unlike physical assets or cash, the value of your skills and knowledge doesn't depreciate with economic fluctuations. When you invest in yourself, you're increasing your future earning power. This means that the time and money you spend on learning new skills or gaining new knowledge will pay off in the long run. You're becoming more valuable to employers, clients, or customers. This increased value translates to better job opportunities, higher salaries, and more career flexibility. And as your skills and knowledge grow, so does your ability to command higher compensation. This isn't just about earning more money, it's about securing your financial future. This is crucial during inflationary times because as the cost of living rises, your income needs to keep pace. By continuously improving yourself, you ensure that your earning potential remains robust. The key is to focus on developing in-demand skills that align with your interests and career goals. Whether it's through formal education, online courses, or hands-on experience, the effort you put in will be worth it. There's tons of research showing the incredible return on investment that education and skills development can provide. The more you learn, the more you can earn, and the more secure your financial future becomes. So, while everyone else is worried about inflation eroding their savings, you can be focused on building your most valuable asset, yourself. Remember, the best investment you can make is in your own growth and development. For those who prefer a more hands-off approach, I want to leave you with a simple but powerful portfolio strategy that aligns with Buffett's principles. This strategy is not only easy to implement, but also highly effective in safeguarding your investments against market volatility and economic uncertainties. It's called the 90-10ths rule, and it's designed to help you weather inflationary storms. This rule is a testament to the wisdom of diversifying your investments while keeping a significant portion in growth-oriented assets. Here's how it works. You allocate 90% of your portfolio to stocks, specifically those of high-quality businesses with pricing power. These are companies that can maintain their profitability even when costs rise, making them resilient in various economic conditions. The remaining 10% goes into a diversified basket of real assets like real estate or commodities. These tangible assets tend to hold their value and can provide a stable income stream. This could be through direct investments or through low-cost index funds or ETFs. These financial instruments offer a cost-effective way to gain exposure to a broad range of assets. Stocks over the long run have historically outpaced inflation. They offer the potential for significant capital appreciation, which is crucial for growing your wealth. They represent ownership in businesses that can adapt, innovate, and grow their earnings over time. This adaptability is key to thriving in an ever-changing economic landscape. The real assets provide a hedge against inflation and further diversify your portfolio. This diversification helps in reducing risk and enhancing the stability of your investment returns. The 90-10 portfolio has not only outperformed inflation, but also delivered solid returns during challenging economic times. By following this strategy, you can build a robust portfolio that stands the test of time. So there you have it. Warren Buffett's blueprint for not just surviving but thriving during inflationary times. Instead of fearing inflation, view it as an opportunity to make smarter investment decisions. By focusing on businesses with pricing power, avoiding the traps of bonds and excessive cash, adding real assets to your portfolio, investing in yourself, and considering the 90-10 rule, you can position yourself to come out stronger. If you found this video helpful, make sure to like, subscribe, and hit the notification bell. Thanks for watching, and I'll see you in the next one.